Hello everyone, Richard Morris here from Morris Succession Lawyers. Been a little while since my last video. Obviously we had quite a bit of drama and uncertainty coming out of May's budget, but things have moderately settled down to a degree in the sense that we've seen some common sense prevail when it comes to testamentary trusts being exempted from some of the application, just in terms of that flat rate of 30% marginal tax rate that was going to apply to trustee level. So that's now been removed, but there's still a little bit devil in the detail when it comes to the treatment of testamentary trusts. You've still got a situation where you don't want a trustee of a testamentary trust to retain income. You've got the highest marginal rates applying in that instance. That's pretty standard. It's been the way that trust law or taxes operate in a trust law sense for a long time now. As I said, 30% flat rate's gone. In terms of passing on tax benefits or income splitting between different beneficiaries of a testamentary discretionary trust, you can still do that as long as they're individuals and income tax exempt beneficiaries, which are charities, effectively not-for-profits. But they have excluded companies and other trust type structures from being beneficiaries if you want to avoid that 30% marginal rate. So I think the key takeaway at the moment when it comes to testamentary trusts is that there's still a lot of benefit there from a tax perspective. The asset protection advantages are still alive and well, and those are unaffected and weren't affected by the recent budget. But it's more that taxation issue that was arising from the first announced budget on the 12th of May. Since then, they've made that change. So the tax benefits for individuals is still positive, but when it comes to being able to use other structures, that ability to pass income and capital through a testamentary trust to another company or trust, that's been lost at this stage. Whether we see an amendment to that arrangement once we have a change of government, I know opposition parties certainly are indicating that's likely to change from their perspective. I take a fairly cynical approach in the sense that if things have been set in place for the next 18 months or so, 12 to 18 months, then maybe there's going to be a little bit more reluctance to unwind everything if there's a change of government, but we'll just have to wait and see. So at the moment, testamentary trusts are fine if they're structured correctly. Most of the trusts that we would do allow for variations of trust deeds to be made, and it does allow for individuals to wind those up or potentially exclude or amend those classes of beneficiaries prior to assets going into them. So it's still positive, still worth a review, worth a discussion with your advisor. If you do have a family trust that's operating now, it's a good time to get in touch with your advisors and talk to them about what may be in store from a restructuring perspective. We've got rollover relief from the 1st of July 2027. That's a 3-year period. The key being that it may give you some exemptions from a tax perspective, but that doesn't, or at the moment hasn't flowed through to state duties. So you may have significant stamp duty liabilities arising if you've got a family trust that has real estate. So worthwhile having a discussion. I think it's something that probably is more of a wait and see type scenario. I would like to see what happens moving towards the end of next year, as far as if we're likely to have an election and whether the promises that have been made from other parties are likely to be kept, and whether we're likely to have a change of government at that point. I wouldn't necessarily be rushing into major restructuring, because you may incur significant stamp duty issues and end up with a structure that could have been just left had you waited. So I think it's a wait and see when it comes to family trusts at this point. Obviously, there's still some other exemptions as well. You've got primary production, so if you're in the business of farming and are a primary producer, then these changes to trusts don't apply to that income. Special disability trusts as well are exempted. They're a specific sort of trust that is effectively Centrelink approved, that doesn't affect a person who has a disability They're trusts that you can create during your lifetime. So if you had a child with a disability, you can actually put money into a trust during your own lifetime, and it can hold up to an amount. It's an indexed or a threshold that changes. From memory, it's about 700,000 off the top of my head. So you can put that much money into the trust, doesn't affect their Centrelink entitlements. So fantastic from that perspective. They're heavily regulated and they're quite rigid in terms of how they apply. There's a model trustee that you generally adopt. That can also be set up within a will. It's something that we do fairly regularly if the circumstances are right. So they're not caught by this flat marginal rate of 30%. Fixed trusts, that could be a trust, often called unit trusts, for instance, where you might have set fixed percentages or fixed parts that different beneficiaries receive. You can also have a fixed trust in a will. You might have a very simple will with maybe two children, and they receive their inheritance when they turn 25, for instance. That's a fixed trust where there's no other beneficiaries. They just get their specific half and they receive it at that point in time. There's a lot of shortcomings to that type of trust. Generally avoid unless it's smaller sums of money. Deceased estates are also exempted, so whilst you're in that estate administration phase, you're not going to be hit with the 30% flat marginal rate. And then obviously when it comes to testamentary trusts, there's still a little bit more detail to come out. As it was before, income must be generated from inherited assets, so you can't push assets into the trust after someone's passed away that have come from outside the inheritance and then expect to get the same tax treatment. That's always been the way for a long time. Nothing really has moved there. It's more these words about it must be for genuine testamentary purposes. That's one thing that's still causing a bit of alarm and concern amongst the estate planning lawyers and accountants, that what is that going to mean down the track? If it's in a will and the trust are created in a will and you're doing it on your death, I don't really see how it can't be for a genuine testamentary purpose. But little bits of terminology and jargon within what's been released, we need to see the detail on those aspects. So overall, positive news that we've had that revision from the initial budget, but still more detail to come. So watch this space.